Valens Research, Uniform Financial Analytics.
Right now, we're seeing names much like that, like Google, which we think is a really interesting name. And the obvious question that I'm sure you're asking is, that's great, but how do you come up with an idea like Google? What is the uniform accounting factor that drives it? And so what I'm actually going to do is I'm just going to hop out from the newsletter for a moment. And I'm actually going to go into, for Google, for Alphabet, G-O-G-L, and show you what are the insights that we're seeing and how do we come up with a name like Google. So if I jump, and now I've just gone into the actual Valens Research app itself. What I'm looking at here is what Google looks like right now. And what you can see is Google is a name that has historically had phenomenally strong profitability. But what's important is while they were growing robustly over the last 15 years, ROAs consistently were falling from 110% down to 30% in 2014. When we saw that, that told us, okay, this is a company where truly this is a company that's investing, and as they invest, ROAs are declining because, right, they aren't able to invest in a company that's as high performing as the classic search business. But what's interesting that jumps out to us is, while the market is pricing in ROAs to continue to fall, ROA has actually been really level for the last 4 years. And part of the reason for that, when we do fundamental research on the name, is we can dig in and we can say, in 2015, something important happened. They had a new CFO come in, and that new CFO was really focused on understanding how do we control costs while still being able to invest in growth. How do we grow rationally? Ruth Porat from previously from Morgan Stanley. She came in and she really restructured Google to say, we are going to continue to invest in growth. You can see even after she became the CFO, this company still grew at 20% a year each year, but ROAs started to flatten instead of declining. Well, the market's still pricing ROAs to decline, and the market's also pricing slower growth. If we think that Ruth can continue to do that, then we've got a name that's potentially undervalued. And if we look, we don't just have a name that's undervalued from a company versus itself in terms of what the market expectations are. When we also look at Google, right here, what we can see, this is a comparison of Google versus all of its peers, right? Because sometimes we know, like in areas like in the auto sector, you can see that the whole entire sector itself is undervalued because the market has a structural view in terms of what's going to happen to the business. But what we can look at here is we can look at what are the ROAs that Google has produced relative to the multiple the company trades at relative to its asset base. What you find is there's a very strong relationship between these two values, right? Companies that that generate a return that's around corporate average trade at around 1x book value, while companies that trade higher returns trade at higher valuations. You can even see here how if you see there's a trend, right, in terms of this relationship. What's interesting is if we see Google is right here. So if we look, Google is at the low end of this trend if we were to draw a channel here, which is significant because even though it's at the low end of the trend, Google is growing at 22% a year. So we can see that Google is valued like it's one of the lowest growing of its peers when it's actually one of the strongest growing. We can look at that too if we see in terms of the valuation matrix. What this shows us is we can see ROA, what the value of Google's stock should be, right, given different ROAs the company could produce and different asset growth. If you remember, right, Google has ROAs at around 30% right now. If Google just has ROAs that stay at 30% and grow at 20% like they have, this is a company that's a double, right? For this company to be overvalued, for it to be expensive, we need to see ROAs be cut by a third, and this company that has never grown by less than 15% a year to grow on average 5% a year over the next 5 years. Those expectations are so low that that's part of the reason why we came up with it as a conviction long idea. And lastly, the last tool that we use when we're looking at a conviction long idea to identify whether or not it looks undervalued or not is we're actually looking at what do we see in terms of management and their sentiment and strategy for the business. Not just what's priced in, but what does the management team think that they can do for the business? And what's telling for Google, which has it on our conviction long idea list, is we see a management team that's confident about growing user base, confident about growth opportunities in areas like healthcare, and most importantly, considering that the market is pricing in ROAs to fall, is we actually see Google as a company where management is not concerned about expense pressures. So you can imagine when we see all those drivers for Google, all of a sudden we have a reason that we highlighted as a conviction long idea list just like all of the other names that we produce on our conviction long idea list and our equity ideas each week, and the names that we actually produce on our conviction long idea list, which we produce on a quarterly basis, and our clients also get. For context, that just gives you a bedrock of what Valens can do and what uniform accounting can do in your process, just using our newsletters, and also just by taking you through how we came up with Google as an idea. You can also see how you could use uniform accounting to do your own individual investment research.
Valens Research, the world's leading source for uniform financial analytics.